Hello, dear students. I am Arsalan Kayyum, the instructor of financial accounting. So today we are going to learn about the basic financial statements, chapter number 2 of financial accounting book by William Haka, Bettner and Carcillo, 17th edition. So it is the introduction to financial statements. Companies prepare interim financial statements and annual financial statements. So the financial statements can be divided into two broader categories on the basis of their duration of preparation. The duration of preparation contains two categories. One type of financial statements are prepared on annually basis, so they are known as annual financial statements, and the rest of financial statements like quarterly financial statements and semi-annual financial statements are known as interim financial statements. So, interim financial statements are prepared for a short-term bird-eye view of the business performance, and annual financial statements are prepared usually to publish for the general public. Dear students, there are basically three types of financial statements, three main financial statements. The fourth one is there are basically four types of financial statements, but we will, for the purpose of understanding of this chapter, we will concentrate on three types of financial statements, which are number one, balance sheet, number two, income statement, which is also known as a statement of comprehensive income. And number three is the statement of cash flows or cash flow statement. So these are primary, we can call them primary financial statements. Okay. The fourth one is the name of the fourth financial statement is statement of owner's equity. So, but for the focus of this chapter is on these three types of financial statements. So we will focus on them first, and then we will concentrate on the fourth one. Okay. We will use a corporation, a joint stock company, to describe these statements. Okay. So a corporation, the businesses are divided into three types: sole proprietorship, partnership, and joint stock companies. Joint stock company is also known as corporation, in which there are a huge number of shareholders participate their share to form a business. So number one, first financial statement is the balance sheet. The balance sheet is also known as the statement of financial position. The statement of financial position of a business at a specific point in time. This is very important. So it shows the financial position of the whole business at a specific date or at a specific point of time. It describes the financial position or where the enterprise stands at that specific date only, because otherwise the next day the financial position, with only one transaction, the financial position of the company may be changed. So it shows the financial position of the business at that specific date. For example, usually the statements are prepared, the balance sheet or the statement of financial position is prepared on 31st December every year, which is known as the closing date of the business, or 31st June of the year. So this date, this specific day or date, when we will look into the financial matter of the company and the performance of this company at that specific date, so it is called the balance sheet. The next statement, important in a financial statement, is income statement, which is also known as statement of comprehensive income. So this type of financial statement has two important things, which is very easy to understand, which depicts the revenue and expenses for a designated period of time. So it is very important. This statement is not showing a specific point in time. Rather, it is covering a period of time. So it is covering the whole period of time. For example, which is starting from 1st January of any year to 31st December of that specific year. So this income statement is covering all the transactions happened related to the revenues and expenses of that company for the whole period. So it is not showing the financial position at any specific point or date in time. Rather, it is showing the profit which is generated from the activities that happened throughout the period, starting from first day to the last day of that year. Okay, so the simplest formula of to find out the profit or loss of the company is when we subtract expenses, all the expenses, whether they are direct expenses or indirect expenses. We will cover them in detail. Okay, so there are two types of expenses, whether they are direct expenses or indirect expenses, and we subtract them from the revenues. So revenues minus expenses, we if the answer is positive, then it is called income or profit. When the answer is negative, it is called loss. When the answer is negative, it is called loss. And when the answer is positive, it is called income or profit. Okay. When we talk about the income statement, we have learned that revenues minus expenses will generate whether if it becomes positive, the answer is positive, it will be called as income, or otherwise it will be loss. So let's talk about these two things, okay? Whether and the flow of cash related to that. When the revenues are increased, they generate positive cash flows. So it is mentioned here, revenues result in positive cash flows. For example, a business is selling more and more products. When the sales are increased, their revenue will be increased. On the other hand, expenses generate negative cash flows. It means the more the expenses a business is occurring, the more outflow of cash is happening in that specific business. So expenses result in negative cash flows, negative cash flows. It means outflow of cash. Revenue means inflow of cash, okay? I have already stated earlier that net income or net loss is simply the difference between revenues and expenses. So when we subtract expenses from the revenues, either we get income when the answer becomes positive. If the answer if we get the negative answer, then it contains loss for that business. So normally in accounting, we try to write the loss in the bracket form. So bracket is showing the negative or outflow of cash. Okay. The third primary financial statement is the statement of cash flows, or you can also say it cash flow statement. Cash flows, as the name says, cash inflows or outflows. It has two major concerns, whether the cash is coming into the business or whether the cash is going out of the business. So if the cash is coming to the business, they are known as inflows, and If the cash is going out of business, it is called as cash outflows. So when do we receive cash, or when do we call them as cash inflows? The simple example is that if we are selling more and more goods on cash, we receive more and more cash from different customers. So it's a cash inflow. It's the major source of cash inflow. And the expenses, we are paying salaries, we are paying rents, we are paying electricity, utility bills, or etc., or anything, or salaries or wages. So cash is going out of the business. So one important thing is, we have already studied the balance sheet is prepared at a one point in time. Okay, it shows the one specific date, the financial position of a business on a specific date. But income statement shows the profit or loss of a specific period of the whole duration, the whole period. Okay, it is not showing the financial position at the profit and loss at any specific point. Rather, it covers the whole duration. In the same manner, cash flow statement is also covering the whole period of time and the transactions that occur during that period. Okay, it depicts the ways cash has changed. The cash changed means whether inflows or outflows, whether the cash has increased or decreased with all these transactions during a specific period of time. Okay, so two important things to revise: income statement and cash flow statements are prepared and they depict for the whole period of time, the whole duration of transactions. But on the other hand, the balance sheet depicts only the financial position at a specific point in time. Okay, one important concept is the business entity concept. We have covered the three primary financial statements. Now we'll try to look at some different concepts before going into the details of how to calculate the financial statements. The concept of business entity. Okay, it says that a business entity is separate from the personal affairs of its owner. So business entity has its own recognition. A business entity has its own recognition or realization. On the other hand, the owner of the business has its own recognition in the society. A simple example is that you always notice that the stamp the stamp of the owner is always different from the stamp of the business. So the stamp which is marked on any legal paper, the stamp of the business is always different from the stamp of the owner. So owner is different from the business. Okay, so business has its own entity in a society. Okay, which is a man-made form of any type of person. It is also called, we can say, as a person, an artificial person. Okay, okay, let's have a look at the first statement, which is also known as the statement of financial position or the balance sheet. Or let's have a look at the format of a balance sheet. A balance sheet can be prepared in two formats, whether in horizontal format or vertical format. The, in this form, it is captured in the horizontal format. The horizontal format is that in which assets are written on the left side and liabilities and owner's equity are written on the right side. Assets are written on the left side and liabilities and owner's equity are written on the right side of that sheet. So that's why it is called horizontal. On the other hand, if liabilities and owner's equity are written under the assets, if the assets are written first and then on the same column, or we write liabilities and owner's equity under these assets in the same single column. So it is known as vertical balance sheet. Okay, so there are two formats. So let's have a look at these the format and the major division of. So basically, balance sheet or statement of financial position has parts, three major parts. Number one, on the left side, these are assets. On the right side, there are liabilities and owner's equity. So liabilities and owner's equity. Okay. So the assets means all those resources a company can use to generate revenue. I'm repeating that all those resources a company has that can be utilized to generate revenue. So assets can be divided into two main streams. Number one are the current assets. So these are all current assets, and the rest are fixed assets. Current assets means all those assets which can generate revenue within a very short period of time, like 1 year. And on the other hand, all those assets that can generate revenue uh, for more than 1 year are known as fixed assets or non-current. These are also known as non-current assets. Okay. So current assets include cash, notes receivables or account receivables, and supplies. The fixed assets include land, building, office equipment, but they are not limited to these only. Okay. We can also include other assets in these categories as well. Liabilities. So the liabilities also can be divided into two parts. Number one, current liabilities and non-current liabilities, or the long-term liabilities and short-term liabilities. So, but all these liabilities that are mentioned here, these are short-term liabilities, means they are payable within 1 year, in less than 1 year. Okay, notes payable, accounts payable, salaries payable, and then owner's equity. It means equity means the share of the owner. So owner's equity means has two things: the capital stock. Capital stock means the shares of the owner, and the retained earnings. Retained earning means all those earnings which are set aside from the profits, all are known as retained earnings. So the profit, when the profit is earned, some part of the profit is divided among the shareholders of the company, and the remaining profit is set aside for future use in the retained earnings. Okay. So balance sheet can be divided into three main parts: assets, liabilities, and owner's equity. Assets can be divided into short-term assets or long-term assets, and or current assets or fixed assets. In the same manner, liabilities can be divided into short-term liabilities, long-term liabilities, and owner's equity have two parts: the capital stock and retained earnings. Okay. So liabilities mean the payables of the company, the obligations of the company that the company has to pay in the near future on the or in the far future. Okay. Hope I'm clear. Let's let's go to the next slide. Okay, students, this is the definition of asset. So asset, all on the left side of this balance sheet, contains assets. So assets can be current assets or fixed assets or long-term assets or short-term assets. So assets are economic resources actually. These are all economic resources that are owned by a business. This is the property of the business. Okay. These economic resources include cash, notes receivable, accounts receivable. Receivables means that they have to receive money from the customers. They are all still assets of the company. Okay. Supplies means office supplies like like the stapler or printer or computer. So these are all considered to be supplies. means all those things which are used for office work are known as supplies. Okay, sometimes we write inventory in place of that. Inventory means all those things which are purchased for the purpose of reselling them, so it is known as inventory. So these are all assets of the company, these are all economic resources. Land, building, office equipment, all these resources are economic resources. They are owned by the business and are expected. Okay, what are expected? And are expected to provide positive future cash flows. So they will generate future positive cash flows. So assets have, number one, assets are economic resources. Okay, they are the property or owned by the business. This is the second thing. And the third thing to remember, they are expected to generate positive cash flows. Everybody starts a business with the view to capture in mind to generate revenue in terms of positive cash flows. Nobody will, anybody will never think uh, about generating negative cash flows. Okay, the owner will start the business and he will pay the money out of his pocket again and again all the time. So it's not possible. Either he will liquidate or finish or wind up the business. So three things are important for the assets. Number one, they are economic resources. They are owned by the business, and these assets can be used to generate positive cash flows. Okay, hope I'm clear. Okay, students, the next slide is about some principles related to recording the assets. Okay, number one is cost principles. The cost principle says that all the assets are recorded on their cost value at which they were purchased. Okay, all the assets will be recorded on their purchased value or the price at which they were purchased in the past. Okay, second, going concern assumption, it says that the business seems to be generated for an unforeseeable future. It means, in the simple words, we can say that the owner will not have the tendency to wind up the business in the near future. The business is always established to generate for an unlimited time period. Okay, the business is not started to wind it up in a near future, to close it up in the near future, to finish it up in the near future. Rather, the businesses are made to grow in the future. Okay, so going concern assumption means a business remains in contact and will continue for an unforeseeable future, for an unlimited time period, until or unless there happens some bad things and the business will go finish or wind up or liquidate. Okay, for example, the owner, if the owner dies, the business will automatically be closed. I'm talking about the sole proprietorship. Okay, but some businesses will flourish, and if the owners dies, except that they still continue to flourish. Like the big organizations, you can have an example of Apple company. After the Steve Jobs, it is still flourishing. It is still getting more and more customers from anywhere in the world. So we have lots of businesses in our society, in our surroundings, that are growing even if their founders have died. Number three is objectivity principle. Objectivity principle mean that whenever you're recording the transaction related to the assets or any other transactions of the business, so objectivity says you must record all those transactions which can be objectively verified. Okay, and you cannot give your subjective opinion to record that specific transaction. In a simple example, I will try to explain it. Okay, the simple example is that if I say that I am the owner of the business and I'm the sole proprietor of a business, and I say and I am expecting that in the near future I will get a good handsome amount from somewhere. uh, for example, a lawsuit is going against me in the court, and if I will win, and I am expecting around 90 to 95% that I will win that case, and if I win that case, then I will get a good handsome revenue from the government. So this is my expectation. This is my subjective matter. This is not the objective matter. Okay. So this is my subjective opinion regarding that expected revenue. So, but I cannot record that revenue, that expected revenue in my statements, in my transactions, in my financial statements, because that specific revenue is not verifiable, is not still verifiable until or unless they are verified by someone else. If you get the receipts of that revenue from the government, then you can all these receipts can be verified by some auditors. Okay. Another simple example is that, uh, for example, an external auditor, uh, must always check the receipts of each and every transaction that happened into the business. So when the audit is performed in a business organization, they check the random receipts of different transactions. So to verify that the transaction has some base. Okay, if without any base you're recording the transaction, so it is considered as null or void in accounting. Okay, hope I'm clear. And the last thing is that, okay, the last concept regarding the transaction is stable dollar assumption. It says that the transactions should be recorded at a stable dollar value. The dollar in which, or the amount, or the measurement at which you're recording the transaction, that measurement criteria must have a stable dollar in value. I mean, it must have the stability principle. It can be explained in a very simple example. For example, I say that if a company has started the transactions to record in the Canadian dollar, okay, and after some time they have started some transactions in New York, and with those transactions they have changed their measurement criteria from Canadian dollar to American dollar. And so this change or this shift of measurement from one measurement criteria to another criteria will lead to some uncertainty, okay, some confusion. So if you are taking one criteria to record a transaction, then it should remain the same. Okay, for example, you're recording the transaction in Pakistani rupees. So if you are in the future, if you're going to change that with Indian rupee, then it will create confusion for the readers of financial reports. Okay, so stable dollar assumptions say that if you are choosing one measurement criteria, then you should go for it for unless the business is in contact. So if it is a going concern concept, then all those years in which it is a going concern, it should use the same measurement criteria to record all of its types of transactions. Okay, so it is stable dollar assumption. Okay, let's move to the next, liabilities. Liabilities are presented on the right side of the financial position statement of the business, means the balance sheet. The right hand side in the horizontal format. So there are two types. There are two parts of the right side. Number one is liabilities, and the second is the owner's equity. So liabilities include short-term and long-term liabilities, or current and non-current liabilities. But here, if the notes payable are payable in within less than 1 year, so they are considered as current liability. If they are payable for more than 1 year, then they will be considered as the long-term liability. Okay, accounts payable as well here, salaries payable. So all these things are all payables which will be paid if they are payable within 1 year. So they are known as short-term liabilities. So liability, what are the liabilities actually? Liabilities are debts mean obligations that represent negative future cash flows. It means they are going out of the business. They are not coming into the business, they are going out of the business. Okay, if I'm gonna pay the notes, I will pay in cash or check. If I'm going to pay the accounts payable to my all my suppliers, if I'm going to pay the payments to the suppliers, then it will be a future cash flow outflow. It will be a negative future cash flow or cash outflow of the business of an enterprise. Okay. So liabilities are actually the debts or obligations which will be paid in the future. So they are related to the future. Okay, so that's why we call them payable, payable. All these things will be paid in future. Okay. The third part of this statement of financial position or balance sheet is owner's equity. So owner's equity is written normally below the liability side. Okay. So owner's equity represents the owner's claim. It is the owner's claim. The owner can be one, owner can be single owner can be two owners, or there can be many owners in a joint stock company. Okay. So the claims of the owners in an organization. So the claims of the owner can put a claim in the court against what? Against the assets of the business, because all these assets are purchased with the founder of this business. The owner is normally considered as the founder of the business. So he can claim against all the assets of the company. I have already mentioned the owner can be a single owner. In partnership, there can be two or more owners. But in a joint stock company or corporation, there can be many owners. Okay. So all those owners can claim against the assets of the company because they have a very good share. They have a good share in the business. So it contains two things: capital stock and retained earnings. I have already explained them earlier. Okay. The owner's equity, um, if the business earning is increasing and business is generating more and more profits, the owner equity will be increased. The owner equity will decrease by two things. Number one, business losses. If the business is going down, or the payments to the owners, if you are paying more payments to the owners, then owner equity means the share of the owners. If you are paying more payments to the owners for their personal use, for their home use, it means their equity, their share is getting down and down and down. Okay. And due to all those business losses, the owner equity is getting down. And it's getting up from two things. Number one, if owner is making more and more investment, owner is making more investment into the business with the passage of time, so owner equity will be increasing. And if second thing is, if the business is earning more and more profits, the owner's equity is getting up and up. Okay. So dear students, in this lecture we have studied about the basic or primary three types of financial statements, and the format. We have also learned the format or structure of the first statement, which is financial statement of financial position of a business, or the second name is balance sheet. Now in the next lecture we will go through the accounting equation and some in detail the other types of transactions, in detail their sub items, Um, Take care. Bye bye.